And so diving into the next offering, which is Rogers Business Park Opportunity 73, very similar in terms of business plan of Eastwood, in terms of we want to get in there, get our hands dirty with the tenants, and maintain relationship and increase rents. A lot of what we feel from a market research standpoint and other similar properties in this location, this is a property in a submarket of Houston, Texas, Bullshire, which this particular submarket is one of the wealthiest, or part of one of the wealthiest counties in Texas, which is Fort Bend County. Within a 3-mile radius of our property, there's an average household income of almost $200,000, which is, for a Texas, pretty high. If you look at the percentage above Houston for those stats, the actual, dead center Houston, we're 83% above that. And so this is a very, kind of arguably higher end submarket of the Houston, Texas market. In here, we feel there is a stabilized value add. This was a newer construction property. I believe, don't mark my words, I believe it was constructed in 2021, approximately. So a lot of these tenants have, more recently in the recent years moved into the location. In all of our tenant interviews so far, tenants have loved the location. It is obviously newer construction, as you'll see, very presentable to a customer as they drive into this business park. Business parks are unique, and we've done a handful of stuff like this where you can have a mix of tenants. Something like Eastwood Village, that's going to be, a lot of larger corporate tenants with maybe some, local tenants on the inline, but it's primarily retail, where Rogers Business Park, it's very similar to the business park that we hold our headquarters here in California. It is flexible in terms of the types of tenants you can get in there. And that's nice. Again, we always want to look at the downside risk protection. This is a debt-free offering as well. But if we lose a tenant, who are our tenants as options to replace? And something like the Rogers Business Park, you have retail, you have restaurant related, you have cafes, you have actual businesses, you have flex space. If you look at this property, you'll notice there's kind of industrial flex, small, warehouse approach. So you have a wide range. There's almost 100,000 square feet of mixed-use retail industrial at this property. It is 99% leased as of today. And as I mentioned, we have local retail, service retail, industrial tenants, very diverse mix, staggering leases. If you look at the market rents, and there's a couple Class A retail centers that are also being developed in this market within our vicinity, so arguably, and those rents are going for $23 to $25 a square foot. Our average number is approximately, for our retail-related clients, a little over $17. So we feel we have room to increase rents. We also have room to keep our tenants, because if our tenants were looking to leave and move to another spot, they're going to be significantly increasing their overhead. And in a market like today, in the coming years, as a business owner, you're going to be cognizant of that. And this is already a very well-located property in a well-located thoroughfare. And then you look at the industrial rents, because as I mentioned, we have a mixed use asset. And so we're looking at the different types of tenants here. You look at the industrial rents, the average rents in the market are around $19. Ours, there's some tenants as low as $17. So there's a little room for growth there. And I think, again, as you have this kind of flexible asset of types of users, it insulates us for the downside protection. And yes, we can lose tenants in anything, any property, any piece of real estate out there. Everybody knows you could have vacancy. But what we're looking for is markets that have low vacancies in the submarket, and that checks the box on both of these assets. Then we look at the direct asset and look at the historical occupancy and the full Shire, newer building. As I mentioned, 2021 construction, but it had a fast lease up. You know, whenever you build a brand new building, that's the thing you kind of look at, is what was the demand for the location. And so we're really excited. We feel that there is some meat on the bone, some potential value, but from a stabilized approach. You know, we're not buying necessarily a 50% occupied or a 60% occupied center that we're, promising the moon to bring it up to 100% occupancy. We are bringing a stabilized approach that gives us opportunity over the next 3 to 5 years to increase rents, control expenses, improve the tenant base, and hopefully have a very healthy outcome for our investors. But most importantly, having that staying power to protect the investors from a lender issue. So if anybody has questions on those two DSTs, those two debt-free DSTs, please feel free to reach out to myself or anybody on the K Property side. We can dive into those deeper, and/or we always welcome property tours as well. We have a great team that can meet you at any asset.
So if you visit kpi1031.com, you'll be able to log in for free access. And then also you'll get a number of different resources available to our investors on kpi1031.com. You get a free book, 1031 DST properties. So we'll send you a copy of that. A free subscription to the 1031 DST Digest magazine, which has all sorts of case studies, tenant overviews, educational resources and articles in the 1031 DST Digest. You'll get access to free educational 1031 DST conference calls. We host weekly conference calls every week with our investors on various topics regarding 1031 exchanges, asset classes, financing, debt-free, zero coupon offerings, different strategies to use when thinking about a 1031 exchange into DST properties. You get very, very educational conference calls. We'll get you access to those. Our team's here to help. We've done a lot of these DST transactions. We've helped thousands of investors nationwide complete 1031 exchanges into DSTs. We're here for you. Reach out to us at any time, and just really appreciate everybody taking the time to join us today.